carry forward this conversation and bring on board Karan Taurani as well from Senior Vice President at Elara Securities. Karan, thank you so much for joining in with us. Good morning. And what's the thought, Swiggy versus Zomato? First, let's just start with that, right? What are you seeing in terms of trends, and how do you see the market share moving between these two leaders in the space? So how are you seeing this going forward also?
Hi, good morning. So I think it's a typical comparison, Swiggy versus Zomato. We've been seeing since the last so many years that Zomato has outperformed Swiggy, and that trend continues from here on. Whether it is on growth rates, whether it is on better take rates, whether it is on profitability, I think execution by Zomato has been far superior versus Swiggy, and that trend continues. Now, two, three things to note here. One is, I think Zomato has been very proactive in certain things. One very big lever for the advertising, one very big lever for the profitability rather, is the advertising revenue. So I think if you look at Zomato's take rates, we've seen a sharp improvement from a range of about 17.5 to 18% to 20% plus. And the bigger driver for this is because of the ad revenue. I think that they've been a winner over there very clearly. Second, big lever is the platform fee. Platform fees have been hiked, constantly over the last 8 to 10 months. And it started off from about 2 rupees, and today in some markets it's about 5 rupees, and potentially this could go to even 8-10 rupees. So I think these are the two levers that differentiate Zomato versus Swiggy in terms of profitability. As far as restaurant commission and take rates are concerned, I think both platforms are largely at par. And also in terms of growth profiling, I think Zomato has been far superior versus Swiggy. I think on the food delivery front, we may not see much of differentiation as far as GOV is concerned, because we haven't seen any trends in terms of a sharp market share increase, for Zomato. I think that market share number is very much on par, where Zomato has, got an edge versus Swiggy. But one is on the profitability front, where execution has been very superior. And secondly, if you look at the overall growth rates, there's a big difference because Blinkit obviously has, seen very sharp growth and acceleration over the last 1.5, 2 years as compared to what Instamart would have seen, and Blinkit has gained significant market share. I think today, as per our assessment, Blinkit is the market leader as far as quick commerce is concerned. So I think because of these two, three differentiating factors, Zomato's performance has been far superior.
Right, we're talking about right now the quick commerce, the Blinkit side. Now, even right now, when you're looking at the commentary that's come in, what we understand from processes is that quick commerce is doing well even for Swiggy. And overall, that competition is increasing, right, in the quick commerce space. So how are you valuing all this on the basis of that? And do you think that Blinkit then will be managing to hold on to such strong gains that it has been seeing in the last few quarters?
Right. So see, the quick commerce segment is untapped. So the industry itself is, seeing strong growth. And Swiggy, having a reasonable amount of play, I think as per assessment, they would be somewhere close to about between 20 and 23% kind of market share. Definitely, they would also grow, because of the market itself growing. But the question here is about outperformance. The question here is about very good execution. I think if you look at Blinkit numbers, quick commerce as a segment, Blinkit has come much later as compared to what Instamart would have come. And despite that, Blinkit today is, at least about 30-40% higher market share as compared to what an Instamart would have. So clearly there have been, execution challenges as far as Swiggy Instamart is concerned. And basis that, I think the valuations for Swiggy, both on the food side and on the quick commerce side, will be at a discount, versus Zomato. But things can definitely turn around. If Swiggy was able to turn around in terms of execution, profitability, growth, the valuation discount can converge, and probably it can even trade on par. Now, to the question in terms of the competitive intensity, that is something which is growing all this while. It is nothing new. I think we have seen Big Basket making very strong inroads here. Recently, Jio has announced their plans to come into quick commerce, not quick commerce, but yes, delivery sort of a situation wherein they'll deliver within 30 minutes, which could be something similar to a quick commerce proposition. We've seen Flipkart announcing their plans to come into quick commerce, and all the existing quick commerce players are expanding very aggressively. I think they are all interested in terms of doubling their store count because they don't want to miss out on the opportunity, because the growth is huge, opportunity is very big, and there's a very rapid movement as far as growth and consumption and adoption is concerned. So clearly nobody wants to miss out on this huge untapped opportunity. So yes, a good time for the quick commerce segment. But what will differentiate here is user experience, the lead times, who's able to deliver in that lead time of 10, 12 minutes, who's able to deliver, whose product assortment is better as compared to peers, because these are key differentiating factors. And also what will differ in terms of monetization, who is able to get good ad revenues, who's able to go for a break even path, who's able to attain profitability, right? So even Zepto recently raised money, they're also trying to double their stores. So the opportunity is huge, everybody will grow, but execution in terms of ad revenue, in terms of product assortment, in terms of user experience, and in terms of the overall profitability, these are the things which are going to differentiate between the players.
Quick commerce is clearly untapped, but the competition is heating up. Zepto just doing the fundraise, and that was expected to perhaps start a fresh war as well. But there's lots to talk about with you, Karan, right from PVR to the Alcobev industry, because ABD's IPO is just opening today. There was that news from Karnataka yesterday with respect to the reduction in the GST slabs. Talk to me about that in terms of Alcobev. A, what's your view on the ABD IPO, if you have a view? And secondly, what's the implication of this Karnataka slab changes on the likes of USL and other companies?
I think in terms of valuations, what they're getting listed at potentially about 8,000 crores or market cap post listing. I think the valuations are fair. We may not see any big listing gains fundamentally, basis the numbers and the growth rates and the margin profile they have. Two, three things to monitor here. The first is the revenue growth profile. Rather, if you look at the revenue growth, it is very heavily skewed towards the regular segment. And we all know regular segment in a country like India, wherein you are seeing a lot of adoption towards premiumization, the growth rates in terms of volume may not be that strong. And the margin, obviously, for ABD, this segment makes healthy margins as compared to peers because the dependence on glass is very low here as compared to peers. So that is a very good thing for them. But broadly, the growth rate in this segment is not very, very compelling. That's one. Secondly, on the premiumization side, I think they don't have too many brands which have seen very sharp volume growth. If you look at brands like Sterling series, if you look at the brands which is OC Blue, these are the brands which they have in the P&A segment. If you look at the brand volume numbers over the last 2 to 3 years, it's been very stagnant in terms of brand performance and volume of take. I think Iconic White, which is a new brand launched about a couple of years ago, that's the only brand which has seen massive traction. So there's an over dependence for the P&A segment. And Iconic White has to really perform in a very strong manner for the P&A volume growth to be good from here on and healthy from here on. So potential market share gain is somewhere going to be a challenge because they are over depending on Iconic White as a brand. I think the third thing is profitability, right? So if you look at the margin profile of the players or rather the peers in the spirit side, United Spirits core Alcobev EBITDA margin is about 16.5%. If you look at the likes of Radico, they are somewhere in the range of 12 to 14%. So for ABD, I think margin profile is also very poor. They're at about 7 to 7.5% EBITDA margin range. Obviously, we believe that going ahead, margin improvement will come because there are multiple levers that they have. They are backward integrated by almost about one third. There are other levers in terms of gross margin improvement for the industry as a whole and for ABD. But even after the margin improvement, let's say if the margin even improves from 7% to 9%, we don't foresee ABD trading at a valuation which is on par with Radico. And currently, the listing, I think they would come at a price of almost about, which is 25-30% discount valuation versus Radico today. So for this discount to converge, I think execution is a key here. The margins need to move towards low double digit. Volume growth needs to be very strong towards 10-12%. And the blend has to be made in terms of growth and profitability. So not much to be made in listing gains as such, but yes, if the execution is correct, if there's a consistent performance which is there, then obviously the multiples could get related towards more closer towards Radico. The second thing is on the Karnataka. So the slab which has come, I think there is no impact for this for now for the beer industry, but definitely is good news for the spirits industry because they reduce the duty in some slabs. And as per our assessment and as per our checks in the industry, the impact is quite significant for the premium, brands here. So specifically, there are brands which would be priced at an MRP of 1,500, 2,000, 2,500. For those, there could be an MRP cut of at least 10 to 15% based on the new slab system that Karnataka has implemented. So definitely very strong volume growth of take that one could see. Because if you look at Karnataka as a state, liquor is most expensive as compared to its peers in the state, which is Telangana, Kerala, everything put together. So definitely this is a big relief, to see very strong volume of take in Karnataka. And as we all know, most of the larger brands have got exposure in Karnataka. Karnataka, in terms of volume contribution, contributes about 14-15% of volume for the whiskey industry as such. So I think United Spirits will see a positive impact here because they have a very large P&A portfolio and their Scotch portfolio is very heavy in their pricing range of 2,000 rupees plus. So United Spirits will have a positive impact here and Radico as well because Radico also has multiple brands in the whiskey segment which are 2,000 rupees and above.
An overall view there. But since we have you with us, Karan, curious to get in your take on PVR Inox. The stock hasn't been performing all too well on a year-to-date basis, down 20%. And one would imagine with, the OTT releases that have been coming up and the kind of competition that it's been presenting itself, is that something that it cannot ignore, or is the fact that we have some pretty promising releases lined up going to be a silver lining?
Yeah, I think with PVR Inox, we need to be more patient. I think if you look at the first half of calendar year 24, it has not been great. It's been a very muted performance. Two, three reasons to blame here. One is, of course, the large ticket Hindi films have not done well. The likes of Bade Miyan Chote Miyan during festive season, the likes of War, what we had estimated, in terms of box office, have been below par. Secondly, if you look at the regional films, I think because of elections around the corner, we haven't seen too many large ticket Tamil Telugu films, and regional contribution in terms of box office has increased in the post-COVID era. So dependence on regional content is very high now as compared to the pre-COVID era. Third thing is writer association strike, which we all know has led to a big change in terms of the content flow for Hollywood. And Hollywood does contribute 15-20% for the multiplexes as far as box office is concerned. So therein, I think we'll start to see momentum, post September, October. So because of these three reasons, the performance has been muted. Going ahead, there are green shoots, but I don't think one should expect anything spectacular in the second quarter of FY25. I think the momentum will start to pick up in Q3 FY25 because that is the time when you'll see festive season. That is the time Hollywood will make a comeback. That is the time we have got large ticket Hindi films which are releasing. That is the time where even regional film like Pushpa 2 is going to come, which is consistently being postponed over the last 6 months. So I think Q3 is where you'll see the best performance of this financial year in F25. Q2 obviously will see acceleration versus Q1 because of a muted base. So yes, good times ahead. The momentum will pick up in Q3, and post that it's not going to sustain in Q4. But yes, on a momentum basis, Q3 is a very good quarter to monitor the momentum. But Q2 definitely will be better versus Q1.
Will be better than Q1, and Q3 surely will be a one to watch out for. Thank you so much, Karan, for joining in with us for all those updates from Zomato, Swiggy to PVR. Thanks so much for joining in with us this morning.
If you like this video, then like, share and subscribe to ET Now.